Welcome to this week's version of Nichols and Dimes, our weekly video series. The quote of the week this week comes from Carlos Slim. Carlos Slim, hello. You probably heard of him before. If not, Google him. Very successful businessman who said, with a good perspective on history, we can have a better understanding of past, present, and thus a clearer vision of the future. So in my opinion, the key here is a good perspective on history. Carlos Slim. So what am I talking about this week? I'm talking about active versus passive investment management or investment philosophy. So let's first define what each of those is. So per the Motley Fool, by the way, Fool.com is a very good financial website. If you ever get around to reading on financial matters, which I'm sure most of you do, Fool.com is a very good resource. So Fool.com talks about active versus passive investing. So let's define an active management or an actively managed fund. So there are three goals. Number one, the goal or intention is to outperform an index. So the goal of an actively managed fund or strategy is to outperform a benchmark like the S&P, the Dow, the Russell 2000, Russell 1000, the NASDAQ, or whatever the heck your benchmark is. Could be bonds, real estate. So again, to actively outperform the benchmark. Number two, they generally have a human being to manage the portfolio. Actively managed funds, again, have a human being generally to actively manage the portfolio, an analyst and a research department and so forth. And they also tend, because they have a lot of attention, if you will, on what it takes to manage that strategy, they tend to have higher fees associated with them. So again, active management, those are the three general characteristics. On the other side of the coin is passive investment management or passive investing. That intention or that goal is to really match the index. So in other words, if the goal is to match the index, say for example the S&P 500 is up 10%, a passive strategy or fund return on the S&P will be about 10%, minus fees as an example. So again, the goal is to match, not beat, in indices. The second goal is, or second characteristic is really just defined by automation. They're not, these passive funds are not generally managed by a human being or even an algorithm. There is potentially some human oversight, but again, it's basically buy and hold. So we're buying an index or an indice or an asset class, and we're just basically leaving it alone, and with the goal, of course, over time of that asset class or benchmark appreciating. And the third characteristic is those strategies, passive strategies, tend to have lower expenses because, again, there's a lot less work. So basically, you're buying and holding. So again, is active management or passive management better? The reality is that you probably should have both because each of these strategies or methodologies do better in different types of markets. Now, there's generally three types of markets. There's an uptrending market, there's a sideways market, and a downtrending market. And generically speaking, a passive investment strategy will do better when we're in a bull market. So when the markets are, or an asset class is generally appreciating, it's generally better to have a passive investment approach, a buy and hold investment approach. Conversely, when the markets are not good, like they were in February, March of 2020, or when we have a big downtrend, it likely makes sense, and usually active managers outperform the indices. Why? Because they tend to have a more proactive approach where they're tactical, maybe they're raising cash, maybe they're selling stock short as an example to help hedge. So again, what should you have? Generally, you should probably have some of each because the reality is over a long period of time, some strategies, again, a passive strategy might outperform an active, and other periods of time, an active might outperform a passive strategy. So you may have some of each, you may not have some of each. So if you don't know, maybe it makes sense to get a second opinion. To that end, if you would like a second opinion on your portfolio to determine if you have an active management strategy or a passive passive management strategy, you could send me an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com, go on our services tab, click on Second Opinion Service to check us out, and certainly fill out that form, and one of our advisors will contact you to see if we can help. Thanks again for watching. Bye-bye.